allow them to fail.
Were you aware of the few senators who raised real concerns about removing Glass-Steagall, about what would happen?
No one that I'm aware of saw it clearly. You point out to some senators and congressmen who did, but somehow we described them as being peripheral. And I simply said they're wrong. Turned out they weren't.
I think we will, in 10 years' time, look back and say we should not have done that because we forgot the lessons of the past.
Senator Dorgan predicted disaster, and disaster is what we got in 2008.
Yeah, no, and disaster, it wasn't solely Glass-Steagall because much of the disaster of 2008 would have occurred independently of it, I believe, but certainly the propagation of the problem throughout the economy was greatly aided by the absence of Glass-Steagall. You know, we would have hit the iceberg anyway, I believe, but the ship would have had compartments which would have been flooded, and question is, would the whole ship have gone down? Because had it been compartmentalized, we still would have had a disaster. It still would have involved very important institutions, but it might not have spread throughout the whole ship. That's the real issue.
What do you think they saw that Wall Street didn't see?
They simply didn't participate in the exuberance. But I do think that, you know, this setting up the deck of cards so that we could produce what we currently are trying to withdraw from turns out to have been something that the word disaster is maybe not strong enough.
Well, some people now say the deck was stacked, that the game was rigged against the broad interest of the public.
No, I definitely agree, and I mean the proof is there. It doesn't take a genius to figure out that we'd been wrong.
But it takes somebody principled to admit that I was wrong?
No, it's not something you like to end your career with. That is for sure. No, look, we got carried away. It wasn't any small group. It was a consensus that reached the press, it reached the political world, it certainly it reached the intellectual world. I'm now, as you know, at MIT, and I say to some of my academic friends that the intellectual underpinnings of this was created at MIT and places like that.
With the technology, the computers?
Well, no, it's the mathematics. It's all of this mathematics of finance and the presumption in much of this mathematics that you can capture risk by looking at historical volatility and so forth and so on. As soon as you say something appears not to be risky, you get an overinvestment in it because the capital requirements are less. And then if something does go wrong, the hurt is all the more because you don't have the capital to take the risks. And, you know, if somebody says, walk across that sheet of ice, there's no danger whatsoever you're going to fall in, you know, you're fine as long as you don't fall in. But
the board of MIT suggesting that human intelligence no longer runs our financial system?
Well, it's a little wisdom, balance, and judgment wouldn't hurt.
So how did so many people, including yourself, get it wrong?
We were carried away by the enthusiasm, and like everything else, you know, once you start, you probably go a little further than you should have. We started out lending mortgages to customers and putting them on our balance sheet. Then in the 90s, when the mortgage-backed securities came into being, we found that you couldn't economically do that, so we would package our mortgages and we'd sell them to a Wall Street firm who would then pass them on to their customers. Pretty soon, we were in the business ourselves after the merger, and so all of a sudden these mortgage-backed securities could be distributed throughout our own company, and pretty soon people said, well, why only package the securities that your customers create? Why don't we go out to mortgage brokers and start buying some of their securities, and we'll package those and we'll sell them? And then I was retired at the time, but you read in the press, and you may even have seen on television, no doc. Now, no doc, low doc means no documentation, or low documentation. Low meaning less than the regulators would require of you.
You didn't ask the person, the homeowner who was buying the house, show me proof of your wages, show me proof of your savings.
That's right. But can you imagine that you publicly acknowledged that you were creating products and selling them into the market that had no documentation or less than normal required documentation? And this was, it's sort of like taking a product and putting a skull and cross, saying this might be poison, and putting it on the supermarket shelves.
You know, I hear you talking, and I think, well, human beings certainly can go insane. So can systems, right?
Yeah, and so can groups of human beings. In the 90s, the investors took over. And they basically said to management, we don't care what you do. We don't care how many private jets, houses, golf courses, swimming pools, whatever you have, as long as you keep the share price going up. If share price goes down, we're going to get rid of you, even if you're good. And managers started being scared of their stockholders. And this idea of shareholder value came into being. I never heard the word shareholder value till the 90s. It was customers, customers, customers. How are the customers? Are we doing well? Are we losing place with the customers? But all of a sudden, and Sandy was a total proponent.
Sandy Weil.
Sandy Weil. I mean, his whole life was to accumulate money. And he said, John, we could be so rich. Being rich never crossed my mind as an objective. I almost was embarrassed that somebody would say out loud. It might be happening, but you wouldn't want to say it. But you know, the biggest bonus I had ever received when I was at Citi was $3 million. The first year I worked with Sandy, it was 15. I said to the board, I'm the same guy doing the same job, same company. There are two of us. The company's bigger, but there are two of us. What's going on? Oh, you don't understand. And it was just totally different culture. And see, Wall Street developed that culture.
That's what happened, isn't it?
It happened. It happened in Wall Street, and there's a subset of the world that self-selects, for whom money is an overriding value. And being personally rich somehow is something they aspire to. And, you know, it's a minority of the population. Bill Gates certainly did not start Microsoft to become rich. Nor do I think Steve Jobs went back to Apple because he wanted to be rich. These were byproducts. They became rich, but as a byproduct. But there is a subset of the population that self-selects, and they go to Wall Street because that's where it's somewhat legitimate. You could do the same thing illegally, but and there are people who do that. I mean, there is a drug cartel and so forth and so on. But the thing that has amazed me is, A, it's fairly large, and two, it's sort of been accepted.
How do you explain that?
That's one of these mind changes. I don't know. When I joined the bank, they said, never put on the bank's balance sheet something you wouldn't sell your mother.
Is this an accurate thumbnail sketch of what happened over this period of time? Banks took too many risks, right?
Yes, they did. But there are worse things, but they certainly
What were
did.
the worst things?
Well, they originated and sold into the marketplace things that should never have been originated.
Derivatives, unregulated
Well,
derivatives?
it was the excess mortgages, the no-doc, low-doc mortgages, and then the derivatives were a byproduct. Once you had those, then you could chop them up and so forth. And, of course, they had changed their mindset. They were in the business to make money, period.
The exuberance you said took over. Isn't democracy supposed to be a brake, B-R-A-K-E, on greed and power in the private sector to keep the balance, to keep the exuberance from going too far as it did this case?
It should, but you're a better historian than I am. I don't know, but I would guess that democratic systems tend to go back and forth.
Like a seesaw.
Like a seesaw.
But when you take the watchdog off the beat, as happened in the 1990s, when you lift Glass-Steagall and throw it on the dust into the dustbin of history, you're removing any check in behalf of the public on the exuberance of the private sector.
A consensus developed. The fact that we took it out was a byproduct of this mistaken belief in this modern financial system that was, quote, more efficient, was very lucrative for the United States and the U.S. economy in global terms, and which was supposed to handle risk better. In fact, it handled risk worse. This is what the facts are, because there was a much greater concentration of risk created. And we got it wrong, but the restraint of the government and its agencies disappeared in the enthusiasm. And so it was this combination of the participants getting carried away, the normal checks and balances that should exist against participants, and the thing that is astounding, frankly, and there's a lesson here that is that the system can get it so wrong. It was wrong. It wasn't that there was one or two institutions that got carried away and did stupid things. It was we all did, and then the whole system came down. It became illiquid. The government stepped in. Had the government not stepped in, it really would have come to an end.
Should the